Hey, how's it going? It's Jason Eichmiller, reverse mortgage expert, and right now we're going to go over the reverse mortgage line of credit. The the most exciting and I think the best part of the best aspect of the reverse mortgage. As you could see on the thumbnail, with these reverse mortgage lines of credit, folks who set it up the right way, they're getting between 7 and 9% annual growth on their line of credit. So it's getting bigger and bigger and bigger over the years. So again, not too many people like me talk about it. Truth be told, reverse mortgage originators don't get paid that much on it, but it's so beneficial for you. So I figured it would be a really smart thing to go deep. We're going to go all the way down into the details. This isn't going to be a 10,000 foot view. This is going to be like a 1 foot view above the ground. So we're going to get very granular on this program. So this might be a little bit dry, but if it is, just hang tight with me, especially if you want to learn the ins and the outs of it and how this reverse mortgage line of credit really can work. So I'm going to share my screen right here. And let's see here. There we go. So you can see your retirement's secret weapon, the reverse mortgage line of credit. And I've got 7 to 9% annual growth there. Little dramatic, but the 7 to 9% will actually, I'll show you examples. I've got a guy actually closed. He's funding, was it tomorrow or Thursday? He's funding tomorrow. And I'm so excited for him, and his line of credit is growing drastically. So let's get on with the show here. So let's see here. All right. What you're going to learn today, first of all, how smart seniors are using their home equity to create a retirement safety net. Okay. And this retirement safety net is all due to this reverse mortgage line of credit that's guaranteed to grow tax-free. And as long as you or your spouse live in your home, it's going to be there and it's going to grow. So the ins and the outs, and again, I told you this isn't the 10,000 foot view video. This is down and deep into this program. We're going to go over the credit line details, who can qualify, how it actually grows tax-free, because that's pretty bold saying that that this line of credit can grow and you don't have to pay taxes on the growth, but I'll show you how. And most importantly, when you need the money, because it's your money that you can get, how you can get the money that you need from this line of credit. Finally, how, because with reverse mortgages, some people think that, oh, the bank gets the house or the government gets the house, and I'll tell you that's wrong. But later down the line, towards the end of this, I'm going to show you how you'll still pass your home to your kids. All right. So that's some people don't have kids and they don't care. Others, they've got kids and they say, hey, you know what? I don't want my kids don't need everything, but it'd be nice if they got whatever equity is left over. So we'll show you how that works. First off, just real quick, this is me and my family right here. It's me, Alyssa is my older daughter. Jason is my 10-year-old son. Molly, she's the little girl. She's 8 now. And then that's my wife, Bridget. We were on a nature hike. It's actually on my birthday. You can see my contact information is below. Hold on, I didn't get there. Didn't want to get there yet. Oops, here we go. My contact information is below, and it's also probably flashing on the bottom of the screen. So you can reach me at 888-309-9705. You got my cell number here. Email address is right there, jason@keyhomelending.com. Or if you want information, you can go to reverse. If you want to schedule an appointment, you can go to reversequotes.com and just throw your information on the right, like kind of where I did. And then if you look towards the bottom, if you want to see how other seniors feel about their reverse mortgages, I've got a bunch of testimonial videos, folks that I've worked with who were nice enough to jump on video after we did the loan together, and a bunch of letters and online testimonials as well. So if you want to watch through that and read through that, we've got a bunch of them. I've done this since 2008 and helped a little bit over 450 folks learn about and get reverse mortgages. So it's really awesome to see when we go through this. It's really neat to see that every single person I help is happy with what they did, and they're grateful. And I develop personally, I develop relationships with these folks because this is a big deal, and it helps them out so much. So that's why it's important to me. So first of all, before we get into the line of credit, we're going to do a quick overview on reverse mortgages. Basically, these are government regulated tools. They allow a senior who's 55 and older. Actually, to do the line of credit right, you got to be 62 and older. You can get a proprietary line of credit at 55, but we don't go too much into that on this video because it's not that great. It's not as good as a HECM reverse mortgage line of credit. So you get to take part of your home's value out in tax-free cash without being required to make any sort of monthly payment on the mortgage. You do have to pay your property taxes and homeowners insurance because you still live there. So you own the house. You can live there as long as you want. You can make payments if you want, but most people, it doesn't make sense to make payments when you don't have to. And in the end, whatever equity is left over goes to your heirs. They will either refinance the house if they want to keep it, refinance whatever's owed, or they'll sell the house, whatever's owed gets paid back, and they'll get the rest. All reverse mortgages are non-recourse. That means that if you're upside down, let's say if you owe more than the house is worth, then the government takes over, or the FHA pays the difference. So your kids aren't on the hook, and nobody can ever say, get out of my house. There are no reverse mortgage police that ever come by at any time. As long as you do pay your property taxes and homeowners insurance, and one of you keeps the house as your principal residence. Now, how do you get your money from a reverse mortgage? You can take a line of credit, which is what we're going to discuss today. You can also do a combination. You can get cash up front, monthly income, any combination. Like basically with this program, I design it for every single person that I work with because everyone has their own situation. Everybody kind of has their own needs. So the best way to do it is to mold the reverse around your situation and make sure that it fits as best as it possibly can. You might hear my doggies barking downstairs because somebody might be at the door, but that's okay. We're going to press on, and Lucky can just bark. All right, more on reverse mortgages. They really are it sounds dramatic. They're godsends. Oh yes, they are godsends. They're awesome for seniors who want to live in their home for the rest of their lives, but they don't have a cushion. Whether their cash flow is really tight, meaning that in some cases there's more going out than there is coming in, or there isn't enough coming in for you to live an awesome retirement, or there isn't enough. You don't have enough in savings or investments, and you're kind of worried that if bad stuff happens, you're not gonna be able to make it. So seniors use reverses. They use it to eliminate their mortgage, create a line of credit for future expenses. Again, that's what we're going to go into today. Pay for home health care, which actually the line of credit works pretty well for. Use it to help the grandkids, a bunch of different reasons. And the bottom line is let's use your home equity to help drive your retirement, because your money's just sitting there in your home. If you're watching this, then you're either free and clear on your house, or you have a lot of equity. So what if you could use some of it to make your retirement more awesome? Why wouldn't you use it? So that's a high level of how reverses work. So this is probably you. There's some statistic out there, I didn't feel like looking it up, but the vast majority of seniors want to live in their homes for the rest of their lives. But there's a problem. The problem is that they're worried that their money will run out before they die. And I think it's 60. There's an old Allianz, that's how you pronounce it, study from a few years back saying that it's either 68 or 70% of seniors are more concerned or more afraid of running out of money while they're alive than they are of passing away, which makes perfect sense. Because when you're in retirement, you've got all these issues that come up. You've got future expenses, like you might have home health care. And again, most folks, the vast majority of folks don't want to go to the nursing home. Got home health care, inflation's rising, the price of everything is going up, gas is going up, groceries are going up, but also the stock market is going down drastically. So we have less to draw on. There's an increased cost of living, which I just kind of noted with gas and groceries. If you're just helped a lady in Pennsylvania who needed, like, the cost of her oil jumped up so drastically that she did her numbers and she only had like 2 or 3 years left at the rate she was going. So we did a reverse mortgage to fix all that. The other thing that we can do with a reverse, so those three are frowny faces, but the smiley is if you don't have long-term care insurance, or you want to get living benefits so that if you do become disabled and you want to take money out to get care, you can actually use a reverse mortgage line of credit to kind of self-fund your long-term care insurance. But we'll talk about that later. So kind of teasing on this. I'm terrible at kind of following these slides I just talked, but this is what the reverse mortgage line of credit is for. So we're going to use two examples here of clients that I've helped. In this next one, this is George and Ella. And they're funding their reverse mortgage tomorrow. They closed on Friday. They had a 3-day waiting period, but I'm so very happy for them. They're awesome people. So they're in their early 70s and they live kind of near me. They live in Boca Raton. And George, he's got a decent sized mortgage, but his monthly payment was $1,278 a month. So, I mean, that's a decent amount of money, but he's still working. And his investments, by the way, he likes what he does, but one day he does want to retire. And his investments, which would keep him afloat and were pegged to last for the rest of his life, they've dropped pretty sharply. And now he's worried that his investments aren't going to last the rest of his life. So he felt that weight on his shoulders. I say felt because we just closed him on Friday. Now he's relaxed. But he felt that he was having a tough time kind of dealing with it. He needed to find a solution. His home's worth $795. They owe $146,328 or owed $146,328. He lives a couple miles from the beach, actually, in Boca. Great place. He's got a pool. I visited him, actually. Great. Him and Ella, like, awesome people. So what did we do and how did it work? So we ended up getting George a reverse mortgage line of credit, and here's kind of how it worked. First off, what we did was we paid off their mortgage, and so he just cash flows better, $1,278 a month. That's not a big deal now for him because he's making good money, but when he retires and he's has a job where he's not getting a pension, he'll just be on Social Security. That $1,278 a month is going to be big for him. Then here's the neat stuff about the line of credit. We opened George up. We gave him a line of credit for 202,000 buckaroos that grows at 7.98%. So it grows at almost 8%. And I should say that it's growing right now at almost 8%. And as the rates go up, it'll grow higher. And eventually when the rates go back down, it's going to grow at a lower rate. We'll get into the ins and outs of the line of credit later on, but it is based on the 10-year CMT. So let's look back, though. Let's look at this line of credit that's $202,148. In 10 years from now, that line of credit is going to increase to $341,054. Again, that's assuming that the 7.98 is going to stay the same. I think it's going to jump in the beginning, and towards the end of this 10-year period, it's going to be a little bit lower. It's hard to predict that. So let's say it's going to be in the 300,000 range in 10 years, which is really, really neat. Now, here's something you probably haven't seen because us reverse mortgage people do not release this sort of stuff. Now, I did gray out their last name and their information, so you can't go bug them. But look in the middle where I circled, it says remaining credit line, and it's in red. So, and then if you look at the left, you'll see year 1, year 2, year 3, year 4, year 5, blah, 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 blah. So you can see that the credit line, every single year, it gets bigger. So it starts at 202. So you can see up top, it'll say initial line of credit. It's kind of towards the top left. Initial line of credit, 202, 184. You'll see remaining credit line first year, end of first year, 213, 037. End of year 5, 262, 594. End of year 10, 341, 054. End of year 15, 442, 956. And end of year 20, they'll be 90. I think Ella's younger. So we'd be looking at right there, 575, 305. Not too bad right there. Not too bad at all. And I am kind of jumping the gun. You know what? I'm not going to jump. I will jump the gun. This line of credit, this growth that they get is tax-free. I told you that in the very beginning. I'm teasing it again. And then next, we're going to explain why. So that's George and Ella. How the reverse mortgage line of credit works. Here's where we get granular. Here's where we get a little techie. This is dry stuff. So, but I think it's important, and there's no way to fully educate you about this without being a little bit of dry. So first of all, a line of credit is set up after you pay off your mortgage and take cash. So remember, George had a $146,000 mortgage. So we'll always pay off the mortgage. We'll always pay off whatever's owed on the title, and then the line of credit comes in. So you got the 202 there. And George didn't want any cash up front, but if, say, he wanted $10,000 up front, then the line of credit would have started at 192. Hope you get that. So next, how do we calculate this thing out? It's based on the line of credit growth is based on the 10-year CMT plus 0.5%. So his line of credit growth is 7.98% right now. And again, it'll go up as rates go up, and it'll go down as rates go down. But the cap is the highest they can go with his program is 12.980, so it's 5% up. Now, there is an option to cap it at 17.98, and if you're going to do just a line of credit without owing anything on the house, the 17.98 option works. But if you're paying off a pretty big mortgage and the line of credit is a lesser part of the loan, then I'd probably stick it at 12.98. But I would ask me, call me and ask me about the difference, and I can look at your situation and recommend what at least I think seems smarter. Very important question I get sometimes. The line of credit can't ever decrease because interest rates do not go negative. So the line of credit is going to go up. It's just a question of the pace that it's going to go up. Is it going to go up drastically, or is it going to go up a little bit less aggressively? And it'll all be based on the 10-year CMT. Unlike HELOCs, I should have done a slide comparing, contrasting home equity lines of credit, because for seniors, if you want to live in your house for a while, a home equity line of credit is so scary. It might be one of the worst things that you can do. But the reverse mortgage line of credit lasts forever and will grow forever, even if your home value drops. HELOCs, oftentimes they're only good for 7 years or 10 years. And then depending on the economy, the bank can call the HELOC at any time, leaving you up a creek with no paddle. And of course, you have to make monthly payments on the HELOC, which is no bueno as well if you are retired or if you're looking to retire. So that's why I'm so bullish about the reverse mortgage line of credit as opposed to the HELOC line of credit. So now let's talk about how you get your money from the line of credit. So first off, you can take whatever you want, whenever you want. There's no limitations with the reverse mortgage line of credit, but little fine print, if you do enter bankruptcy, your line of credit will freeze. But if you do a reverse mortgage, you'll be in such a good spot where you won't need to go into bankruptcy. And if I think that you'll be in trouble after getting this, then I won't recommend that you get it. I hope that makes sense. You are not taxed on the growth on the line of credit. So no taxes on the money. And here is why. I've said no taxes a couple times. Here's my explanation. I should have put this in red or bold or something. But you're not taxed on it because you're borrowing the money, and it will be paid back when you pass away or when you sell your home. Thus, when you're borrowing your money, I guess I should say I'm not a tax advisor. I cannot give you tax advice. But when you borrow money, you don't pay taxes on it. Okay? If you have questions, ask your CPA or accountant. Here's another neat thing about the reverse mortgage line of credit. If your line of credit is bigger than your house value, you can take it. Let's use the example. If your house is worth $600 and your line of credit is $700, so your line of credit is $700,000 more than your house is worth, you can take all $700. It's pretty neat. Not many people know that. So where does the line of credit come into play? Where do I like it? I really like it for use for home health care if you need it, to combat inflation, to fight the increased cost of living, to self-fund your long-term care insurance if you're again, younger and you don't have anything set up, what we do, and I'll have a couple examples of it, but we'll use the line of credit to where if you're living off of your investments and they're dropping, especially if you're getting taxed off of them and they're dropping, we will strategically have you use your reverse mortgage line of credit funds in the year that your investments are dropping. And then when your investments are going up, then you use your investments and you let your line of credit grow. And almost every single time, if you use that strategy, your retirement assets will last longer. Pretty cool. So now let's get into some creativity. I'm going to go through one more case, but I'm going to do it quickly so we're not on this little thing here forever. And then we'll go into kind of retirement assets, things along those lines. So let's talk about Jerome real quick. He's 63. He lives in Lake Tahoe. His house is $715,000. He has a small mortgage, but he has low fixed income. He has very high interest credit card debt, which we're seeing across the board. Credit cards right now the interest on credit cards is out of control. So his credit card interest is crazy, and he has very little in savings and no investments. He's basically living Social Security check to Social Security check. And he's worried. He's a smart guy. He knows that if there's an emergency where you got to shell out a good amount of cash, that emergency will bankrupt him. So what do we do for him? How do we help Jerome? We get him a reverse mortgage line of credit again. First off, it paid off his $55,000 mortgage, improving his cash flow. Then he needed $87,000 in tax-free cash to pay off his credit cards. He had a couple small home repairs. By the way, he loves where he lives. Tahoe is beautiful. He has the best setup, a beautiful home, lives by himself, but the nature out there is just, it's gorgeous. And his life is a blessing every day that he wakes up there. So he wanted to fix up his house, and nothing big, but just make it, because he's going to live there forever. He told me, like, man, Jason, you're going to have to carry me out of this place. I'm not going anywhere. So that $87,000 paid off his credit cards and did the repairs. And then on top of that, he's got a $112,254 line of credit that grows tax-free every single year. And Jerome, my man Jerome, is sleeping well at night, in the bed, in the house, in the city that he's going to sleep in for the rest of his life. That sort of stuff. I mean, I can't be happier helping folks like him. It's just, it is true. Without sounding cheesy, it's an absolute blessing to help these folks. So, all right, we heard about Jerome, we heard about George. Now let's take a look at home values and investments, because it's very strange in this economy. So if you look at your house value, and home values have corrected a little bit, they've dropped over the past few months, depending on the area you're in. But your home value is about as high as it's ever been, and your assets are about as low, maybe not as low as they've ever been, but drastically lower than they were before. But let's look at home values. So for the majority of the folks that I work with and seniors, your home is either your biggest asset or pretty close to it. And if you look at Los Angeles, Santa Clara County, and Boca, three areas where I do a lot of loans in. Los Angeles, home prices increased drastically, but now they've dropped a little bit. Santa Clara County, they increased drastically. Now they're just up a little bit over the past year. Boca, Palm Beach County, Florida, property values, they've still settled a little bit, but they're out of control. Everybody's moving here. By the way, this is based on housing market statistics from redfin.com. If you go to Redfin, you can find the same stats that I just found a couple days ago. So if you look here, this is from riskspan.com. And this is earlier because this is kind of like, it's called trailing data, so you don't have data from right away. So this number's dropped a little bit, but look at this. Homeowners 62 and older saw their housing wealth grow by 4.9%, $520 billion during the first quarter of 2022 to a record $11.1 trillion. Read that again, seniors, and I mean you have just about more equity than you've ever had in your life. If we go back to to April or May, you had more equity than you ever had in your life. But it's still, your equity right now is still tremendous. I mean, go back and see Santa Clara and look at, even though it's leveled off, look at Boca. Even Los Angeles is still up, even down 4%. It's still up just like significantly. So that's home values. But on the other hand, investments have dropped. And that's a big concern, because outside of Social Security, what do we live off of in retirement? We live off of our investments. And when they drop, there's less to last during retirement. And remember that Allianz study that I referenced before. It's either 68 or 70, I think, percent of seniors are more afraid of running out of money in retirement than they are about dying themselves. So look at the S&P. From the beginning of the year till now, it's dropped 18%. Individual stocks have gotten clobbered. And the dangers are, and I touched on this, it's called sequence of return risk. Oh, that's the next slide. I'm teasing it. But when you have assets that drop, when you take out of your assets that dropped, that's a double whammy. Then, if you're taxed on those assets that have dropped, and you're taking out of taxed assets that are dropped, that is the quickest way to rid yourself of your retirement savings too early. Here we go, sequence of return risk. So look at these two charts real quick. The left is if you retire at the beginning of an up market. The right is if you retire at the beginning of a down market. And we look at the same investment size, $100,000, the same withdrawals, $5,000 a year. But just look at the return on the far right for both columns. If the return's going up, your investments are going to last a long time. But if your return is going down just for the first few years, look at the guy in green retiring at the beginning of the down market. 1, 2, 3, 4, 5. 5 years of a down market while you're taking out $5,000, so 5%, which I think is a little bit too aggressive. Normally they have the rule of 4, and now it's like 3. But if you take out while the market is going down, your retirement just gets destroyed. Look at the bottom. Retiring at the beginning of an up market, they've got almost $106,000 left after taking $5,000 a year for 15 years. This guy on the right only has $35,000 left. Same scenario. Average return, 4%. It is, and we don't have control over that because we can't tell the market what to do. But what we do have control over is we have control over being able to use our home equity to draw down when the housing market is up, and save your retirement assets when the stock market is down. So that's why CPAs and financial advisors are recommending this reverse mortgage credit line. Stop taking your assets in the down market. I know sometimes you've got RMDs. You can't get away from your RMDs if you're in your 70s or 80s. But don't take more than you have to, right? Use your home equity. Okay, I'm beating the dead horse right now. This line of credit really does provide an extra branch on your retirement money tree. And the bottom line, if you use your home equity when the market is down, your retirement savings will last longer. Whew. Okay. Need a break? I might. I'm gonna take a little sip of water real quick. Homer ate some donuts. Now he's in a food coma. All right. Again, my contact information is probably streaming below if you want to get in touch with me to help. My name, Jason Eichmiller. I run this channel. I run Key Home Lending and Reverse Mortgage Reality. There's my contact information. I'd be more than happy to help you if you need it. So now, in the beginning, I told you I'd promise that I'd share with you. This really doesn't have much to do with the line of credit, but it's a question I get all the time, so I want to answer it very quickly. How can you get a reverse mortgage and pass your house down to your kids? First of all, a reverse mortgage is just a lien on your home. Just the same thing as a traditional mortgage or a home equity line. It's just that you decide when you want to make payments and if you want to make payments at all. You have full ownership of your home, and you can sell it, you can pay it back, or you can refinance it at any time. Most of the folks that I work with, they want to live in the house for the rest of their lives, or up until where life circumstance forces them to move somewhere else. Now, when you pass away, here's what happens. Your house goes to whoever you want it to go to. If your kids, if your heirs want to keep the house, then just refinance or pay back whatever's owed. You have life insurance. Sometimes people couple reverse mortgages with life insurance just to protect their kids. Sometimes they say, you know what? Forget it. I've done a great job raising my kids, and talk to my kids, and they'll take whatever's left over. They've got their own problems. They've got their own family, and the economy's hitting them hard too. So I need to take care of myself. And when they inherit something, they will, but they're not looking out for handouts. 90% of the kids that I talk to and I work with, they're not looking for a handout. They know that their parents' house is their parents' house, and if they can use their house to kind of fuel their retirement along, God bless them. But anyway, your house goes to your kids. If they want to sell the house because they don't want to live there, they can sell it. Whatever gets paid back through the sale, and whatever is owed gets paid back from the sale, and they get the rest. And there is special mortgage insurance on these reverse mortgage line of credits. And any reverse mortgage, if more is owed on the house than it's worth, it protects your heirs. All right, let's do some takeaways. We're almost done. I don't know how long we've been doing. Whoa, 36 minutes. How about that? All right. Home values have increased drastically, but also so have expenses. And when the market drops, you've got lower retirement savings. You combine that with fixed income and all these expenses going up. It's just so hard to survive. It's so hard to thrive in retirement. So we saw on the other slide, if you take too much of your investments or your savings too fast, once it's dropped in a down market, that means that your money might not last as long as you do. And so what do? You use your home equity to offset that. You use your home equity to provide a safety net. And how do you do it? The best way and the safest way is to use a reverse mortgage. All right, I'm going to let you, here's Teresa's testimonial. She's absolutely terrific. If you want to read through that, go ahead. Also, if you want to see some video testimonials, then you can go to reversequotes.com. And I've got a bunch of them up on the YouTube as well. I'm sure you can find that. If you want to learn more, if you'd like to see it, does this reverse mortgage line of credit work for me? How can I use it? How's the growth going to be over the years? What's this? If I have 100,000 in my line of credit, what's it going to be in 10 years? And how can I use that? Man, I'd be glad to help you. Be glad to educate you. So feel free to reach out to me. My name, again, is Jason Eichmiller. I run this channel. My contact information, you can get me at 888-309-9705. You can email me at jason@keyhomelending.com, or you can go to reversequotes.com. And now I'm going to try here to, let's see here. Let's get me back up here. All right, and that's it. That's this presentation. It was way too long, but again, I wanted to be very thorough because this reverse mortgage line of credit, it has so many nuances, so many ins and outs about it, that I owe it to you for you to understand, for you to know how this is, like what this is, how this will work for me, so that you can put your thinking cap on. And again, if you'd like help with that, and if you'd like to see if this is appropriate for you, then geez, just feel free to reach out. And you know what? I guess I didn't have my banner on the whole time, but there's the ticker. There's my contact information. So reach out if you need me. And I really, really, really wish you the very best. Take care of yourself.